Well, the first thing I think to point out is we didn't actually predict the demise of the company. All we did was highlighted what a extraordinary amount of money private equity had pulled out of it. And everyone knew that the float price was miles above the purchase price, but the way that private equity had funded that transaction, basically using the company's own cash to pay the purchase price and then turning around and listing it. So they put in 20 million and took out 500 was roughly the metrics on that transaction in the space of something like 18 months. It was a very, very short turnaround. So the article was mostly around how they did that and some of the tricks that private equity used to get these businesses ready for float. And they're really arbitraging the difference between what matters, which is cash, and what a lot of public market investors value, which is accounting earnings. And they arbitrage those two things to make a lot of profit. So we wrote this article pointing out how they did that, and then the company coincidentally went bust after that, and a lot of people saw in the article evidence that we thought it was going to go bust, which wasn't actually true. But look, it just went viral and it got read very, very widely, and it caused quite a bit of controversy, and we ended up both loved and hated in the media, and we didn't really expect that. And we're a tiny team of people, and we tend to keep to ourselves, and we're not that well connected in the industry. So it was a bit of a shock to the system. Ultimately though, I think, in funds management, brand awareness is really, really important. There's a lot of people out there thinking about what to do with their money, and they just don't know what to do. So if your brand can be one of the ones that people think about, that they come and look at you when they're thinking about where to invest their money, then that's more than half of the battle. You need the right investors, you need the right performance and all those things, but actually just getting someone to look at you is a real challenge. So for us it was, in that article generated 10 times the traffic we've ever had to our website came in the space of a month. So it was huge in terms of publicity, and ultimately it's been, I think, very good for us, although we don't really like the controversy that comes with it. Not really, no, and I don't think I've ever seen anything that extreme, but I think understanding the motivations behind private equity floats is just really important. And I wouldn't say never buy one. If you've got private equity funds tend to have a pretty fixed life of something like 5 to 7 years, and when they're getting towards the end of that period, they're much more likely to sell things for reasonable prices than early on. But if you see something that they've bought very recently and they're flipping it into a float, you just got to understand that the incentives there are for them to get the maximum price they can. That applies to all floats. I just think private equity are particularly good at working out what the market's going to like, how to pitch it, and how to get the business ready for that float. It was really a connection of a school friend of mine, Greg Hoffman, who I ended up in business with many, many years later. But we went through school together, and we ended up playing the ASX stock market game at school, and that was my first exposure to the share market. And I went to Wellington High School out in country New South Wales, and I don't think finance featured heavily in the careers department's shelf in terms of where you could go with your career. So I was very interested in it, and we loved that game, and we came third in the state playing that ASX share market game. I wouldn't say by cheating, but by bending the rules is probably the best way of putting it. It was back in the disc days. There was no internet back then, so they sent you out a disc, and you had 2 weeks to send the disc back with what your new portfolio allocation was, but the prices were real. So you had prices that were 2 weeks old that you could then trade on and say, well, I'm going to put the whole portfolio into this stock because I already know that it's gone up 30 or 40%. Question how we only came third and not first, but anyway, we ended up doing very well in getting some money out of that, and that worked well. I got interested in it, but never really thought about it as a career. So I started studying engineering at university, and that didn't go very well, and I chucked it in after 6 months and went and got a job, and that job just happened to be at the investment bank UBS, and it was pure coincidence. I just took any job I could get, and it was in the mailroom at UBS. So I ended up getting to know a few of the guys there, and everyone talks about those sorts of stories. It's a model for those banks to use the mailroom as a place to get young people in and see what they're interested in and see what they're like, and got to know a few of the traders, played a bit of touch footy with them, and they said to me, look, if you're interested in this and you like it, you need to go back to university. And UBS actually put me through university. They were very kind to me, moved me into the accounting division, and really set me on a path of finance and investing. Outside the investment banking that I was doing as a career, I was always a fanatical value investor, and I'd been introduced to Buffett and Graham and all that stuff by this friend of mine, Greg Hoffman, and I didn't have very much money at the time, but did a pretty poor job of investing what I had, but got addicted to this whole concept that you're buying businesses on the stock market, and if you can work out which businesses are worth substantially more than their share prices, you can do very well out of it. Yeah, I'm largely self-taught, so we ended up buying a business called Intelligent Investor at 25 years old, and I haven't really worked under anyone in the investing space that sort of taught me the ropes and showed me the way, and that's probably why we made some of the mistakes that we did make. But it's been books and conferences and reading people's reports rather than direct exposure to people that's had a huge influence on me. I got a grad job at Macquarie, and I spent 4 years working at Macquarie as a grad. I think in terms of my ability to build a business and ability to back myself in the funds management world, that experience at Macquarie was massive for me. There's lots of, you come from a small country town and you end up working in investment banking, it's a pretty intimidating world. And Macquarie was the place that showed me that you could do it and that you needed to back yourself, and that there are few limits if you're prepared to really apply yourself to what you want to do. So that experience, I think, really set me up to say, well, you can buy a business and you can start a funds management business and you can do all of these things, and who cares whether you're 25 or 30 or 40, the opportunity is out there and you can go and do it. So some of those individual people at Macquarie probably had a bigger influence on me than any big name fund managers. Stepping back from that, so I started the funds management business within Intelligent Investor in 2009. We started thinking about it March 2009, which would have been great from a timing perspective, but by October the market was already up 50% when we actually launched the funds management business. But we had had a near-death experience through the financial crisis at Intelligent Investor. That business shrank from 10,000 subscribers down to 5,000 subscribers, and you get the cash up front and the revenue gets booked as you deliver subscriptions in that business. So we were still paying tax bills on 10,000 subscribers and we were only collecting the cash from 5,000. And we went through some very, very difficult times there. And looking into the abyss for me was a very good experience, because I sat there and I said, you know what, if this all falls over, I've got my friends and I've got my family. I'm generally a happy person and I'm still going to be a happy person. I came through that experience not being defined by the business that I was working for and the business that I owned. And that's been very useful in funds management, and it was very useful in that first couple of years where our performance was pretty woeful. And it does, under the old model, that would kill a funds management business, but we were selling direct to investors, and I think that was the big thing that let us survive and let us get through that period and has let us deliver the performance since, because I wasn't that stressed about it. I thought, if this doesn't work, I'm going to give people's money back and I'll go on and do something else with my life. And I think I could be happy doing lots of different things. I'm particularly happy doing this, but if I was an engineer building bridges, I'd be pretty happy with that as a life as well. So I'm not defined by this. And then the clients were, I didn't have a track record. I'd never run a funds management business. So the people that put their money in were doing so because they believed in the philosophy. They were prepared to commit for a long period of time, and they saw something in me that they trusted and liked, and almost exclusively they stuck by me. I remember one month we had $300,000 of outflows, and we didn't get a lot of money coming in through that bad period, obviously, but it also wasn't going out, and that was pretty important in terms of us sticking to philosophy and doing things for the long term. The other thing that happened was it forced me to define the process a lot more. I did some really stupid things in those first couple of years. And I think if the performance had been great, we would have just stuck with, here's a stock that we like and I've read the past 5 annual reports and we're going to go and buy it. Making some mistakes forced us to sit down and think about, well, what is the process? What is the checklist here that stops us making some of those mistakes? And we've worked really hard to try and define that and make sure that we go through it. And we've probably got the same number of winners that we were having even way back then. We've just got a lot less mistakes and less portfolio exposure to those mistakes. And we still take risk, but we're not having 10% swings at things that can go to zero. And that's been, I think, a very healthy consequence of that early bad performance. So we have a very clearly defined checklist, and a piece of research will typically run to 35 to 45 pages, and that is through from what does the industry structure look like, how many players are there, do you think this company has pricing power, we run through Porter's 5 forces, we run through a competitive analysis. We do all of those sorts of things through to what's the individual company's history, what do the management incentives look like, what's the historical financials look like, and all of that comes together into an idea. So there is a lot of work in that. If you know the stock and you've already done a bit, you can pull it together in a week though, and I think it's important that yes, we do in-depth research, yes, we make sure we check all of the boxes on these stock ideas. The actual idea itself needs to be simple though, and you need to be able to say in a page of work, here's what the stock is and here's why I like it. Because if it gets too complicated, complication means there's more things that can go wrong. So the idea is simple and the work is due diligence for us, saying, okay, you've got this idea, it's a good idea, it's a simple idea, let's go and check that you're right, rather than it. I've never researched myself into an idea, I've only researched myself out. The idea is simple, you know, you pick it up and you look at it, you think this is a good business and it's trading at an attractive price, and then you go and do the work to see whether that's right or wrong. Well, the natural starting point for me is I'm excited about this and it could be a great idea, and then I do more and more work and it leads to a no. So and we have different people in the business. I think some people are very good at being the skeptic straight up. I tend to be a pretty excited, enthusiastic sort of person that comes up with lots of ideas, and that balance for me is the people going, okay, Steve, you might want to think about X, Y, and Z, and yes, that is right. And that's why the process is so important. Your subconscious is really powerful. Your ability to ignore things that might contravene the case that you've already made works at a very subconscious level. It's not something that you sit there and think, well, I'm going to ignore that piece of information. You don't even look at it because your subconscious is going, if you look at that, it's going to disprove the case that you've got over here. So I'd actually say the opposite for me. I start with yeses and I research my way to no. I think experience helps a lot, and for me, I'm 39, but the experience with Intelligent Investor and running a business and then starting a funds management business and going through all of that, I feel like I'm about 60 in some ways. So I think experience helps, and I think you've just got to be wired for it. It's one thing that I've never been able to teach people, to not let your emotions, you know, take over. You're either an emotional person and you probably shouldn't be doing this as a job, or you're someone that is well built to do this type of thing, and you can teach everything else. You know, you can learn how to find stocks and you can learn how to do the research, and all of that side of things can be taught. I think the ability to say, how do you react to a share price falling? Does it cause you to panic? Does it get you excited? That's very, very hard to teach. Yeah, the first thing is that funds management is a much better business than subscription newsletters, and one of the main reasons for that is people in that subscription business, if we produced a good idea and it made money for people, they thought, well, I'm a really good stock picker and what a great idea and I've done well for myself, and the ones that go wrong, they blame you for, so you only get the credit for the ones that go wrong. Funds management, we deliver a number at the end of the year, and if people are happy with it, then they're happy with you, even though there are the same number of mistakes and successes inside of that. I think the biggest issue is what's called the narrative fallacy. I think people are very, very susceptible towards believing a story rather than thinking about the value of a business. And fund managers are very guilty of marketing their funds management businesses on the basis of stories as well, and we do it and everyone else does it. But people come up and they say to you, I've got this great idea, you know, someone walked into the office this morning and said, people are just getting fatter and fatter. I was on the train this morning, how do you take advantage of that as an investor? And someone walks into you and says, well, the population's getting fatter and more obese, and this business plays to that theme, and it's going to grow tenfold over the next 10 years. People just love hearing that story, where the most important thing is, well, what price am I paying for that? And what is the competitive dynamic going to be? You know, what stops a lot of capital coming into that industry that's got a great story behind it and competing away the returns? And I think that's the biggest issue that I see time and time again, and it never goes away, and it works both ways. We make all of our money from buying stocks where, not all of it, we make a lot of our most successful investments have been stocks where the narrative's really bad, and people just don't want to buy the stock because the story is not good, and therefore the price is at a price that more than compensates you for that bad story. This is, I would say, a different opinion from a lot of value investors out there. I don't think the Aussie market in particular is stupidly overpriced. And we started our funds management business October 2009, so that's coming up to 8 years. And the market return, including dividends since then, is 7.5% per annum. Now, that's not crazy bull market returns. You're including dividends in that return. It's not capital appreciation. So I think the overall market hasn't performed that well over a long period of time. It's not bad. It's exactly what you should expect from owning equities over a long period of time. But I'd say over that period, it's gone from fairly priced and it stayed fairly priced. What's made life difficult for us is that the playing field has really leveled out. Over that 8-year period, I would say most of the time there was always one sector or one type of business or a few companies that everyone hated and didn't want to own, and there was this pessimism about, and conversely there were growth stocks up until August 2016. All this money coming out of the big end of the market wanted to buy the latest hot growth stocks, and they were trading at really stupid prices. We were buying mining and mining services companies at crazy prices at the same time. I don't see that diversion of valuation in the market at the moment. It's pretty even. Most things I look at, they're not stupidly priced, but they're also not screamingly cheap, and that's making life difficult for us. It's true globally as well. We've been very successful in Europe over the past couple of years. That market has run very hard, particularly these good quality growth companies that we were buying at really attractive prices 12 and 24 months ago. They're gone and they're not cheap anymore. So I don't think it's a put all of your money in cash or short the market because it's all going to fall over, but I think people's expectations around outperformance and the ability to outperform should be curtailed. Look, we've got a broad mix for exactly that reason. I think the opportunities that we're finding are not in a specific space or place. There's quite a few what I'd call fallen angels on the ASX at the moment. So there are businesses that people were in love with a year ago that have failed to deliver on those expectations. In some cases, I think oversold. We haven't pulled the trigger on many of them, but there's a couple of new additions into the portfolio that fit that mould. In Europe, our focus has shifted quite a bit from these high quality, cheap growth companies. It sounds like a contradiction, but it wasn't a contradiction over there for a while, to some more cyclical businesses that we're still very optimistic about. The economy in Europe is going much better than most people anticipate at the moment, and I don't think that is yet translated into the share prices for some of these cyclical businesses. So we're still finding some cement companies and financials in Europe that we think are very attractively priced. Anything that's got fintech in the name, or look, I think there are a few bubble-ish sectors out there at the moment. I think fintech is one of them. I have no doubt that that space is going to be very active and that they're going to erode the big banks' dominance of the financial services space in Australia. Whether they can actually make money out of it is a different question. And I think that's a really important concept to think about. You don't just need to deliver a valuable service. You need to be able to deliver that service at a lower cost than what people are prepared to pay for it. And I think that's the thing that a lot of people don't think enough about in that particular space. I'm still concerned about the Chinese economy over the next sort of 5 to 10 years. So we're still thinking about the blowback from that on commodity stocks and on the wider Australian economy. And I mean, it's a risk that has been there for the past 10 years and it hasn't blown up, but Australian housing is something that everyone should be thinking about. It doesn't mean you don't have any exposure to it. It's just think about your portfolio. How robust is it to something going wrong here? Because the risk is real, and I don't want to get into the debate about whether it is or it isn't going to happen. I think you want to apply a probability to it, and everyone should be thinking there's some chance that this unwinds over the next, and it could be a long unwind, it could be over 20 years, but what's that going to mean for consumption and household balance sheets in this country? It depends what time frame. Look, I think from 2% net rental yields on housing at the moment, I think the chances of you getting further capital appreciation over the next 20 years are very, very low. Put that at 10%. So people are not going to get a great financial outcome out of paying these prices for residential houses. Is it going to fall off a cliff, or is it going to take 20 years for incomes to slowly grow while house prices go nowhere? I don't know. That's probably a 50-50 trade-off in my view. I wouldn't change a lot, to be honest. I love that Yogi Berra quote, when you come to a fork in the road, take it. And I think that's really important in life, and it's important in investing as well. You want to set these principles around your portfolio that stop you from completely blowing things up. I think outside that, you want to try things with a limited amount of capital, and you want to do stuff, and you learn from experience, and as long as the mistakes are not too big, the mistakes can sometimes be the most valuable things further down the track. And when you've got $3 or $5 or 10 grand, it's actually the best time to make mistakes. And I think if you're young and you're thinking about getting into the space, you shouldn't be investing with a fund manager like me. You should be out there trying to pick 3 or 4 stocks yourself. Maybe you just pick 2 stocks yourself and put your $10,000 into those 2 stocks, and you're probably going to lose it, but you're going to learn the money that you make from that lesson is going to be worth a lot more than the money you lose from the 10,000 you put in.